What's up, Trips?
Morning.
We just completed our 2023 Economic Outlook Breakfast, our 15th annual, and we had our really special guest, Chris Schuba from Helios Quantitative Research. They are one of our data providers. Chris's firm provides economic, market, and some portfolio research that we use in our portfolios. And so we thought we would just do a quick recap of some of the slides we shared and Chris shared for those that didn't make the breakfast. You ready?
Rudy.
So we're always happy to share our very popular asset class returns quilt. The most important thing about this quilt is it shows the top performing asset class in any given year over the last 15 years and ranks them from best performing to worst performing. And the key is investing is really hard without a well-defined strategy. So highlighting a couple of things on the quilt. Take real estate as an example. Real estate went from the outhouse in 2020 to the penthouse in 2021, back to the outhouse in 2022. So trying to create an investment thesis or time when an asset class is going to perform the best or the worst is a difficult errand. Another thing to point out on the quilt chart is there really were only two asset classes in the positive last year: commodities and cash. And commodities, even with the return of 27% in 2021 and 16% in 2022, still have a 15-year average return of minus 2.6%. Some other interesting data points for 2022. Bonds, we use the Bloomberg aggregate bond index as a proxy here. Bonds had their worst year since the index started in 1976. And we'll talk about why that was. So a bit of an outlier on bonds. But there is some good news. So with the Fed raising rates aggressively, moving from a zero risk environment to a more normal rate environment, that also pushed up the income that bondholders are receiving. So we started the year, the US aggregate on the far left was yielding 1.75%, which effectively is $1.75 for every $100 invested. But by the end of December, that same aggregate bond index was yielding 4.68% or $4.68 of income for every $100 invested. And even cash is paying something. You and I talked about it. We did a previous post and video on it, where now the Schwab, take that as an example, the Schwab General Money Market account is paying 4.25% roughly, and even their California Muni version's paying about 2.25% or 2.5% tax-free.
Yeah, it's a great time to revisit how much cash you're holding and where you're holding it, because the world's drastically changed from even a year ago.
And then if we move on to stocks in 2022, you could see U.S. large caps finished down 18%, which feels pretty terrible, but quite frankly is not totally unexpected. After three really strong years, look at 2019, 20, and 21. This is how stocks work. It's not fun to go through, but superior returns long-term come from taking risk in markets. So the key with the quilt is we also show a proxy diversified portfolio, 60% globally diversified stocks, 40% bonds, and effectively means you own all or most of these asset classes in a strategic, data-driven way. And the diversified portfolio is never at the top of the quilt. It's never at the bottom. And you smooths return and an investor's experience over time. And it really was not a great year for diversified portfolio. We talked about how both stocks and bonds were down. But if you look at the return over the last 15 years, a diversified portfolio, even with that sharp down year, averaged almost 5% a year. But it had the third lowest risk on the chart, the far right column of all of the asset classes. And that's the key, is maximizing return for a given level of risk over time. I do want to talk about something I think is really important. There's a phenomenon in finance called hindsight bias. And so we just talked about how bad a year it was for stocks and bonds. And it's easy to look back over what was going on in the beginning of last year and think that these returns would have been easy to project. I knew the Fed was going to raise rates aggressively. I knew inflation was going to be really high, and then the Fed was going to come out and nuke stocks and bonds. Well, there's no reason to feel that way. If we look back over the Fed's own economic release in 2021, the consensus among those members was that inflation was going to run at 2.6% for the whole year. And that's using their personal consumption, expenditures, inflation, which you see on the chart. In fact, inflation hit 7% in June and wasn't below 5% all year. The second key in their release is 12 of the 18 members expected just 3 rate hikes of 0.25% each for the whole year. The other 6 expected less than that. In reality, the Fed raised rates 7 times, but for an equivalent of 17 different 0.25% rate hikes. So it would have been extremely difficult to predict and make some kind of investment portfolio construction change if 400 plus PhDs didn't even expect inflation and rates to rise this fast.
Predicting the future is really hard.
Well, we're going to try to keep getting better at that. Or you want to talk about the inverted yield curve? I thought this was a really great chart from Chris.
Just, at its most basic, the yield curve is a look at what it costs to borrow and lend money. So on the very short end of the curve, you're looking at lending money to the government on a monthly basis. On the very long end of the curve, you're looking at lending money to the US government 30 years out. And normally, you would expect to see the curve sloping upward and to the right, indicating that on a short-term basis, lending money is much safer, so you should receive a lower interest rate. And on the longer end of the curve, you have some more risk. Right now, we're in a really weird environment where you're getting paid more on the short end of the curve, which you can see is the orange line here. And that's why cash, savings accounts, money markets are yielding such high percentages right now. And you're actually getting paid less to lend money for a long period of time. And that's the Fed stepping in and trying to slow the economy down.
Yeah, I thought Chris's main point here was pretty interesting, that, the yield curve has been a pretty good predictor of future recessions, right? When it's inverted, but it's not a perfect indicator. And there's no timing. It doesn't tell you when a recession is going to start, the duration of the recession, the magnitude. It just tells you that the market is expecting turbulent times ahead.
One of the most common topics over the last year has been inflation, right? And the Fed is doing everything it can to turn the tide on inflation. And just wanted to show this chart. It does look like the tide is turning. You can see that inflation peaked around June and has been trending back downwards. If we combine that and we look at forecasts, these are aggregated forecasts of economists, the trend is predicted to continue downward, where by the end of next year, we're expected to be in the 2% inflation range. One thing to note on this, it's a really wide forecast. We see some economists still expecting 7% inflation, and we see others expecting 1.1% inflation. But the general expectation is that inflation is going to continue to come down over the next 2 years. Another topic that is front of mind for many people right now is whether we're in a recession or not, and what that means for your investments. So we talked about this quite a bit in the outlook. Just got a couple of quick slides that I wanted to share. The first is a look at the NBER, National Bureau of Economic Research, the 6 data points that they use to judge whether the United States actually is in a recession. And some of these are negative, but some of the data points are still positive. So we have a mixed bag of economic data. And even though it may feel like we're in a recession, the numbers aren't bearing that out right now. We also see when we look at surveys of economists, there's this wide divergence of whether they actually think we're in a recession or not. If we look at estimates from the New York Fed, they say there's a 7% chance that we're going to have a recession in the next 12 months. If we look at Bloomberg Economics, they say there's a 100% chance. Just another one of those, nobody knows what the future is going to bring. So we'll react as the data changes and update as needed. The next thing to talk about with recessions is really if we actually are in a recession right now or next month, what does that mean? And I think it's pretty important to understand that the data and the stock market are related, but they're not necessarily driving each other. If we look back at past recessions and look at after a recession occurs, what has happened in the stock market for the next 6 months? Generally, things are pretty positive once you get out of that recession. The returns going forward have generally been pretty positive, with the exception of the dot-com crisis. And looking at that another way, markets tend to hit a bottom during the recession and then trend back upwards. So said another way, that we don't know if or when we will hit a recession, but the data also says recessions aren't as important as they're made out to be for the returns of your portfolio.
Yeah, I think the big point that Chris was making too is, given all of this data, it's hard to tell how much has already been priced into the market, right? We spent the whole year figuring out how to value stocks at what is now a 4.25% Fed rate. And we spent the whole year figuring out how to value bonds. And so a lot of that pain very likely might already be factored into this. So a recession may just be a relief. Okay, we finally got it. Inflation is slowing. And now the stock market begins again to look 6 months forward.
And the type of recession that we go into matters a lot as well. Usually Fed-induced, interest rate-induced recessions aren't as drastic as something actually breaking in the economy like the dot-com or financial crisis. One last thing on economic data. This is a chart that if you're a client of ours, you're used to seeing this once or twice a month. it's a survey of over 100 different data points about the economy, distilled down into 12 major categories, and then distilled down into one score. And generally, you can see the economic data was incredibly strong at the end of 2021, and it's been trended down in the wrong direction to where we're now at a score of 30% out of 100%. Generally, lower economic data scores make it tougher for the market to absorb huge shocks. And so we'll continue to monitor this data as it either declines or improves. That may lead to updates in the portfolios that we're managing.
Yeah, and what I really like about this visual is the color coding. For a colorblind guy like me, even I can see it moves from bright green in summer and fall of 2021. It turned pink towards the end of last year.
Yeah.
And, to your point earlier, it's just a great visual of multiple data points distilled down into, you can see exactly what we're kind of dealing with economically as we head into 2023.
Yeah, and there's still some bright signs in the economy. Employment, which we're a very consumer-driven economy, is still a positive. Financial system stress still green, and production is still green. So people have money and they continue to spend it, which I think is why we still see a pretty positive economy. Just one other, I think this is a fun chart to look at, is Chris and his firm went out and put together a survey of some of the Wall Street price targets. And just interesting to see there's this wide divergence of expectations for the market. Predicting the future even a year out is incredibly hard. So we're big believers, absorb the data as it comes and make adjustments, as opposed to setting an abstract target in the future based on an estimate.
Yeah, investing's really hard. And I know we call it the economic outlook, but we're really just taking a bunch of data in real time and taking a look at what that means. Nobody knows what the next 12 months will hold, which is why you need a data-driven, well-defined, disciplined investment strategy. Just look at the top firms in the world have a divergence in opinion between the market going down 6% next year or going up 28%.
Yeah. Do you want to talk about some of the major risks that we talked about heading into this year?
Yeah, I think this was a really good summary. The major risk continues to be inflation. It looks like it's peaked. It looks like the Fed has done their job, that rip off the Band-Aid that caused such a challenging year for both stocks and bond last year, but nobody knows if it's over. The Fed's biggest fear is that they let off the gas pedal, ease financial conditions, and inflation runs amok again. So I think that's probably the biggest risk we see next year, which leads into number two, which is the Fed. Are they going to continue to tighten? Will they? Which I think is the most consensus, that they will take a pause, at least slow down to see what kind of impact those significant rate hikes had last year. And then really the key to all this that makes the whole economy run, over 2/3 of the economy, is the consumer. And the consumer has been strong. We talked about a little bit in the outlook, just travel, any kind of retail was so strong last year. And the consumer is very likely not as in a strong a position. Those pandemic savings, they're dwindling down. You can see the savings rate peaked a while back. So that's one thing to watch, is the strength of the consumer in 2023. Can they keep spending, traveling, eating out, or will layoffs, and will the labor market correct and finally cause that recession that everybody's been talking about. So to put a bow on it, we will continue to monitor the data and react accordingly. We'll keep you updated throughout the year. We will be posting the slide deck and our quilt chart for 2023 to our blog. That's boyd-wealth.com/blog. And please reach out to us with any questions on this. And Ryan and I wish you all the best in 2023.
Happy 2023.